Good morning. Welcome back to another edition of PreMarket PulseScan with yours truly. That's the Algo Capitalist, aka the Vulcan, coming to you live from PulseWaveTrading.com. Excuse me, home of the world famous PulseWave price trigger reports that we put in your hand each and every trading day. If I can stop coughing. All right, so hopefully everybody had a very good 4th of July. Was able to take advantage of the 3-day weekend. For some people, it was a 4-day weekend, and you're ready to get back into the swing of things. As you know, I try to de-stress during weekends and holidays. I normally don't look at news or anything like that. I try to, chill out, push back, and air things out. That's the best way to do things. As you know, you can't always be in front of the screen or all up into news cycles. That is a good way to pretty much go insane. So it's good to push back from time to time. As you know, I did not do any videos yesterday. Gave myself an additional day. I was very busy, had a lot going on. But now we are back. And it seems to be kind of a sprinkling or peppering of news going on. There's a lot of things I have to look into. Thank you for those that you know who you are. Thanks for sending me more information. As far as things that are going on in your corner of the world. Excuse me. And just perusing a lot of stuff. Not a lot going on as far as things that directly impact the market that didn't exist prior to the 4th of July. So pretty much a continuation of saber rattling. You guys know what it is. You know how they do. They want to keep certain things in front of you. They want you to continue to, focus on negative aspects of things. And I try not to fall into that trap myself. I try to stay fresh and just follow the money, follow the pulse waves. Let the market tell me what it wants to do and when it wants to do it, and then I'll take it from there. All right, so first and foremost, what up to everybody in the live chat? What up, Kyle and Swing and Silverback and John and Mick and Brett? Yo, you say they locked down Victoria in Australia? Wow. Yeah, I've been hearing sprinkles of information as far as re-lockdowns. It's just a lot. It's just a lot of stuff going on, peoples. All right, let's get into these markets right quick. Get the news out of the way, market stuff. All right, so first and foremost, you got the Dow futures down 223 points at 25,955. You got the Nasdaq 100 down 27 points at 10,571.5. You got the E-mini S&P 500 down 20 and 3/4 points at 3151 and a quarter. The Russell My Hustle is down 16 points at 1426.70. Bitcoin Futures Composite Index down 25 bucks at 93.30. And you got nat gas up 6 cents at 189. Crude oil is down 37 cents at $40.25 a barrel. The long bond is up 14.30 seconds, trading at 178.13. That's 178 and 13 seconds. Gold futures down $5.60 at 1787.90. Silver down 20 cents at $18.38 per ounce. US dollar index is up 8 pips at 96.80. So we're still operating in that 96 handle, 4 handles away from going to par. We got the euro dollar down 14 pips at 113.20. Pound sterling is up 40 pips at 125.43. Aussie down 21 pips at 69.57. Canadian dollar is up 29 pips at 135.72. Euro yen up 20 pips at 121.65. Let's see, dollar yen up 23 pips at 107.63. Kiwi is unchanged at 65.54. Soybeans down 5 at 901 and a quarter after hitting 909 and a quarter in the overnight market. Corn down 5 and a quarter at 351, and wheat is back below 5 still at trading at 492 and a quarter, down 1. All right, so that's the overnight market prices. Hold on one second. All right, so here is the market news, overnight market news. The Atlanta Fed President Bostic warns of a bumpier road ahead and says the U.S. economy's recovery is leveling off as COVID-19 cases surge. As a second wave of COVID-19 cases continue to rip across the U.S., the Fed's Raphael Bostic thinks this is making the path to economic recovery even tougher. All right, so Boohoo stock tumbles 30%, wiping $1.25 billion off its market value after an explosive report into working conditions at one of its factories. Boohoo shares dropped 30% over 2 days after reports emerged about the fast fashion retailer's appalling condition for its factory workers. Are you running a sweatshop, Boohoo? Looks like Boohoo got busted running a sweatshop. All right, lockdown has created a fresh headache for financial regulators. It's much harder to keep an eye on what traders are up to. Britain's lockdown meant that its financial authority was initially unable to maintain usual levels of regulation over markets. Well, I don't think that's really the issue. You don't need to watch individual traders. What you need to do is watch the big boys, because little Ricky around the corner doesn't have enough money to move a market, but your big hedge funds and sovereign wealth funds do, private equity. Warren Buffett's $90 billion Apple stake is now 43% of Berkshire Hathaway's entire stock portfolio. Warren Buffett's stake in Apple is far and away the largest single stock holding in Berkshire, more than 4 times larger than its second biggest holding, around $22 billion, in Bank of America. JP Morgan, the coronavirus crisis has decimated one of our safest defenses against stock market crashes. Wow. The death of traditional 60-40 portfolios may have been greatly exaggerated before this year, but JP Morgan now says the coronavirus crisis has ended them for good. Of course, long-term investing, the way that Wall Street has always propagandized the public into doing, has broken down. It doesn't work. All right, let's see. My man Sam in the live chat says, I've heard that we need to prepare for a second shutdown that will be more tighter than the last. Yeah, I've been saying that as well. I've been saying that I believe that the first round was just a test run, and that now they're going to release the real virus, and it's going to scare people to death, and they will be real deaths. They won't have to fake the numbers. It'll be real. And the lockdowns will have to be a lot more severe and more panic and more riots and all that good stuff. That's the total, collapsing of the U.S. economy and breaking down of society, which is necessary for them to roll out their plans. So much nonsense. Yeah, Nathan, man, it's all good over here, man. All good. All right. Here's how big companies like Facebook, Google, and TikTok are reacting to Hong Kong's harsh new national security law. Big tech is hitting the pause button in Hong Kong. You think? HSBC to cut 38% of global banking and market jobs in France. HSBC's France seeks to cut 255 of 678 jobs in its French global banking and markets unit by end of 2021 as part of a broader plan to reduce cost, a union said on its website. Didn't say which union, just say a union. All right, earnings coming in. Levi's second quarter 20 earnings and United Supermarket Holdings first quarter 20 are coming in. On the economic front, the Fed's quarrel speech and U.S. three-year note auctions are due. All right, so that's what they got going on today. Not a lot of different things happening. But I will say this, some interesting things. I think you pronounce this Meyer. Meyer stops accepting cash as nationwide corn shortage erupts. Wow. Okay, so there was a recent article talking about the developing nationwide coin shortage sparked by the virus pandemic. And as a result, the shortage, at least one major supermarket chain has removed the ability to pay in cash at self-scan checkout machines. All right, so Meyer Inc., a supermarket chain based in the Midwest with corporate headquarters in Walker, Michigan, announced last Friday that self-scan checkout machines at 250 supercenters would only accept credit or debit cards, SNAP and EBT cards, and gift cards. Wow. And there's a big sign on their door saying, due to national coin shortage, self-checkout registers are electronic payment only. No cash back or bottle slip, Coinstar slip redemption for cash. See a Meyer team member for options if you need to pay with cash. Wow. Quote, while we understand this effort may be frustrating to some customers, spokesman Frank Guglielmi told ABC 12 News team, it's necessary to manage the impact of the coin shortage on our stores, end quote. Fed Chair Powell admitted to lawmakers that the Fed has been rationing coins as the circulation of coins across the U.S. economy ground to a halt due to the pandemic, quote. What's happened is that the partial closure of the economy, the flow of coins through the economy, it's kind of stopped, Powell told lawmakers. Wow, end quote. Wow. He said the shortage was due to the mass business closures that prevented people from spending their coins, as well as a lack of places that are open where people can trade coins for paper bills. Quote, we've been aware of it. We're working with the Mint to increase supply. We're working with the reserve banks to get the supply to where it needs to be, Powell said, adding he expected the problem to be temporary, end quote. Americans Googling coin shortage started to erupt in the back half of June and has since hit a record high. Mainly people in Midwest states are searching for the search term. All right. I have to say, you guys, I have to say that this is very interesting. All right. I think there's something else going on. And I think this is part of that coordinated effort that we've been speaking about. All right. So go ahead and peep this. So you've heard that that's the opening bell for anyone that needs to handle some business. All right. So I have to say, throughout this coronavirus pandemic, you really have heard nothing about the Midwest. Midwest's been pretty much safe, right? And there's a reason that they've been kept safe, is that's because they are doing another test there, which is this coin shortage. Basically what it boils down to, they're using the Midwest to pilot and gauge public response. So they're letting you know we're about to remove money, physical dollar bills and coins from circulation, and we're going to all digital. All right, so this is the preparation that they need to get the people ready for it, to get the people ready to understand this. Okay, that is crazy, man. But you got to admit, we did tell y'all that that was coming. All right, you knew this was coming. All right, so this is a planned, coordinated effort that they would never admit to. Would never admit to this ever. But it is real, and it is exactly what it looks like. Sometimes if things look a certain way, that's because they are a certain way. All right. Hold on one second. I need to fix something here. One moment. All right. Thank you for your patience. Had to work out some technical difficulties on my end. Hopefully, you guys can hear me a little bit better now. All right. So, as I was saying, what they're trying to do is to gauge the public response. So, as we know, too, this was nothing to what they wanted you to think that it was. This whole thing was an epic fail as far as the mainstream media is concerned, because they lied about everything. But now it seems that they've been wanting to have a second round, and they've been trying to prepare you that, hey, there's going to be a second round, so you need to prepare yourself for this. But when you look at the statistics that are coming across, it's not any of that. What it is, it's more of them wanting to push forward their agenda, and they're using you to beg for it, and to love your oppressor. And a lot of people are falling for it. They're falling for the okey doke, if you will. Meanwhile, behind everything, they're pushing all these other buttons and making things happen, and people are just, it's going over a lot of people's head. But all this is coordinated. I exposed and talked to you about how it took them about a year to get this thing off the ground and ready. We saw the earmarks of it. At the time we saw it, we didn't understand, but now we get it. We see now that this is what they were planning for. We just didn't know what it was a year ago. We saw stuff that didn't feel right, and now all of a sudden here we are. I also reported to you guys that what we're dealing with right now is a huge algo shift, and it's rippling across all markets. It's not just one market, two market, three market. No, it's all the markets. Okay, it's all the markets, and people have been totally ignoring these, and I don't know how you can. I don't know how you can ignore all the stuff that's happening. So let's look at it from a different perspective. All right, so it's normal for markets to go through these algorithmic processes and changes, these algo shifts. What are they? Well, it could be a lot of different things. It could be public opinion. It can be mood, sentiment, market sentiment. It can be sector rotations. It can be, people planning from anything from a pullback in the market to a crash in the market to some new invention or something that's going to change history as we know it, change the future as we know it. The gamut is endless, right? But in this latest shift I've seen, I haven't seen anything quite like this. And we are definitely at an interesting juncture in history. All right. Just as the rewards of central bank bubbles have not been evenly distributed, the pain created by the collapse of the bubbles won't be evenly distributed either. We've reached a very interesting juncture in history, and I don't mean the pandemic. I'm referring to the normalization of extremes in the economy, in social decay, and in political dysfunction and polarization. Let's ask a very simple question. The S&P 500 stock index went up fivefold from its 2009 low of 666 to a recent high around 3,400. Did your income rise fivefold since 2009? Probably not. Houses that sold for $150,000 in 2000 are now valued at $900,000, a six-fold increase since 2000. All right, we're looking at almost 1,000% increase, but there's no inflation, right? Did your income rise sixfold since 2000? Probably not. State university tuition has risen about 2.5 times from 2004 to 2019. Did your income rise 2.5-fold since 2004? Probably not. Even burritos from the local taco truck have tripled in price in the past 15 years. Did your income triple? Probably not. The average household income in 2000 was about $42,000 a year. To match the six-fold increase in urban housing valuations, that household would have to earn $252,000 this year. How many households saw their incomes soar from $42,000 a year to $252,000 a year? Not many. The average household income in 2009 was about $50,000 a year. To match the fivefold increase in stock market valuations, that household would have to earn $250,000 this year. How many households saw their income soar from $50,000 to $250,000? Not many. To keep up with tuition, never mind healthcare insurance, the household earning $45,000 a year in 2004 will have to bring home $112,000 this year. The household earning $100,000 in 2004 would need to boost its income to $250,000 this year to keep up with college tuition. How many households boosted their income from $100,000 to $250,000 in the past 15 years? Not many. Healthcare spending has grown much faster than the rest of the economy in recent decades. In other words, what's been normalized over the past 20 years is the total subjugation of labor by central bank inflated asset bubbles that benefit the top 1%. Labor has lost ground while assets have soared, leaving those whose income is earned less able to buy overvalued assets and more prone to borrowing money to maintain their lifestyle, a situation that is called debt serfdom. Remember, the borrower is slave to the lender. 2 generations ago, nobody knew the name of the Federal Reserve chairperson. Now that chairperson is in the news virtually daily. The media exposure of the Fed chair far exceeds that of elected officials, such as the Speaker of the House of Representatives, or the Senate Majority Leader, or the Chief Justice of the Supreme Court. In effect, the nation has become dependent on its central bankers and their limited agenda expand the wealth and power of the financial sector. That's their agenda. The elected government and the real world production of goods and services both have taken a back seat to conjured wealth. Now, the ascendance of finance and the decay of labor's value is the result of ascendance of monetary stimulus as the core driver of wealth and thus growth. It was once expected that consumption would be funded by wages earned by labor, and investment would be funded by savings set aside from earnings. That era is long past. What's been normalized is a systemic reliance on debt to fund consumption and on the euphoric animal spirits of the wealth effect generated by soaring assets such as homes and stocks. History offers a number of parallels to the ascendance of borrowed capital over labor and central bank money printing over the creation of productive value. History suggests eras that have normalized economic and financial extremes of inequality, policy, and decay, haven't ended well for anyone. All right? The fruit of financialization and soaring income inequality always turns out bad. Just as the rewards of central bank bubbles have not been evenly distributed, the pain created by the collapse of the bubbles won't be evenly distributed either. The man at the bottom, the man on the street, always suffers, ladies and gentlemen. Always remember that. The man on the street always suffers. Always, 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 always suffers. While the 1%, they get to leave with the lion's share of everything. All right? It's just the way it is. That is never going to change. I hope you guys are hearing what I am saying to you. All right? So you need to check that. You got to check it. Because right now it's not looking good. It's not looking good. It's not looking good. It's not looking good. And it seems like people are more concerned with rioting and protesting things that they truly do not understand than they are dealing with the facts that are staring them right in the face. And again, it's not going to end well, ladies and gentlemen. There's no way that it can. It can't. but I don't think that's going to stop all the crazy stuff that we've been seeing from happening. People are still going to look to the government to solve their problems. And I think the cycle is still going to continue. Now, here's something that you need to think about too. Now, I've talked about this time after time after time after time on the show, on the YouTube channel. And I've been trying to explain to people that the nature and the dynamics of the markets have changed, but the game hasn't. Hedge funds have been closing up shop since 2008. All right. Now we got another iconic short seller, Lansdowne, closing main hedge fund after worst ever losses. After worst ever losses. While 2020 has been a fantastic year for retail day traders, now that Jerome Powell has lowered the IQ requirement to trade options to those of a 10-year-old, hedge funds continue to suck for the 10th year in a row, with shorts hit especially hard. It's called the short squeeze, ladies and gentlemen. And it is live and direct, live and in effect. And it may not stop for a while. So just be ready for that. All right. Which is why it was not a surprise that in the latest hedge fund closure news, Bloomberg reports that once iconic Lansdowne Partners is shutting its main hedge fund in a shift away from short selling after being hit by some of its worst ever losses. The London-based investment firm is closing the $2.8 billion Lansdowne Developed Markets Fund, according to a person with knowledge of the matter. Investors could withdraw their money or move it into the Lansdowne Developed Markets Long-Only Fund or a new LDM Opportunities Fund, which will invest in early-stage companies, said the person who asked not to be identified because the information is private. Now, they're about to experience an even greater loss with the long-only fund. See, right now, they're saying, okay, we believe that the central banks are going to continue to prop the market up. Therefore, if you're long, then you won't get hurt and you won't get punished. Not true. Long-only or short-only funds is a recipe for disaster. You need to be able to go both long and short in the markets, or you're not trading. Trading by nature is going in and out, long and short, not just long only. All right? Because even in long only funds, you know, there are pluses and minuses to everything. If you're a long only strategy fund, well, guess what? That means when the market is bearish, you have to be on the sidelines in cash. And while you're on the sidelines in cash, your money's not going to work for you. Now, traditionally, they had their day in the sun because the correlations of the markets were efficient. If the stock market was down, the long only fund didn't have to sit on the sidelines in cash. You would just get long the bonds and you would make your money that way. Or you put some money in gold and silver and you would make money that way too. All right, because they were negatively correlated. But now that the Fed has quote unquote broken the markets, you don't have those correlations anymore. You will have days where both bonds, precious metals, and the equity market will be falling together, going down together. So what is a long-only fund to do in those situations? There's nothing they can do unless they decide, okay, we're gonna buy SPX put options. All right, that's a choice. All right, because you're long only. You're not taking any. You're not selling short. All right, or you could go into inverse ETFs, which are available, which were not available 50 years ago. You could do that. You still have some options. You don't have to stay in cash per se, but just remember that there are pros and cons with options too. They're not designed for long-term holding. They're designed to go to zero at expiration. Even if you buy leaps, you're paying through the nose for that comfort and for that time. The time value is what you're paying for, and it's going to be astronomical. And then even still, you're still going to have to deal with decay and erosion over time. The longer and stronger the bull market, the more decimated those put options are going to be. All right, so long only has its pros and its cons, but in the last 10, 15 years, it's been more cons than pro, even though over the past 20 plus years, we've seen the advent of inverse ETFs and SPX options trading. So even with that being said, it's a long only fund. Is again, you're fighting Mike Tyson in his prime with one arm tied behind your back. All right, that's what you're doing when you take a long only strategy today. Like I said in the past, it had its day in the sun. There were things you could do, but nowadays, with the high frequency trading and all the different computer programs and models running simultaneously across all markets and across continents, you're really making it so that you cannot operate in the market if you take the traditional fund manager approaches. All right. So now the firm says it will continue to bet against companies in some of its other funds. And the move marks a dramatic retreat by one of the world's most famous equity long short hedge funds and comes after poor performance in both rising and falling markets. See, again, just with that alone, that already tells you what kind of model they're using. I already know what kind of model they're using. Okay, so here's the problem. If a fund is losing money in rising and falling markets, what it's telling you is that they're doing what is called counter trend trading. They're buying sell-offs. They're catching the falling knife, and they're standing in way of the train when the market's going up. So it's a counter trend trading type of an approach. The reason why people used to like that back in the 90s is because a lot of people have spent time in Vegas and Atlantic City, and they're very keen to the martingale approach. And that's basically what this fund was doing, is using the martingale type of approach where you're using a prescription that is comprised of both Bollinger Bands and Sigma Bands, and you're looking to, on an intraday as well as daily basis, but more so on an intraday basis, you're constantly buying the market as it's falling, and you're constantly selling the market as it's rising, hoping that it won't get to 2 and 3 Sigma on you or 4 and 5 Sigma on you, and vice versa. Same thing with the Bollinger Bands. So I don't know why they thought that would work. That is probably the most losingest system in the world. And I have tested hundreds and if not thousands of methodologies, systems, signals, indicators, you name it. And I can tell you from actual trading experience with real money, that approach does not work. And now, to be fair, it had its day in the sun too. There was a time period when markets had very long sideways congestion trading. And on an intraday basis, that methodology had its place back then. But the markets have changed. All right. And that technique will no longer net your profits. I'm just saying, you don't believe me, go ahead and try it yourself. And when you lose all your money, you can come back and tell me about it. But that approach will not help you. So at any rate, this is another firm that is going the way of the dodo bird. Years of poor returns have led to hedge fund outflows from Lansdowne, its assets dropping to just $9.8 billion in June from a peak of nearly $22 billion. According to Bloomberg, the firm's main hedge fund, run by Peter Davies and Jonathan Regis, tumbled 13% in March's rout, the biggest monthly decline since it started trading almost 2 decades ago, and was down 23.3% in the first half of the year. Woo! The firm has told investors that it's become harder to make money with short bets of companies, and it's finding opportunities in long bets and investment in early stage companies, the person said. So basically, they're switching from trading to private equity, and basically they're looking to become some type of a white knight and become a venture capitalist. like a synthetic crypto venture capitalist. And they said it right there. They're looking for opportunities to make long bets and investment in early stage companies. That's the actual definition of private equity and um, being an angel investor or venture capitalist. That is the quintessential definition of that. So they're gone. They're out of here. Adapting to these new centrally planned times when shorting is virtually illegal, Lansdowne was already managing more money in its long-only funds than the other strategies. At the start of March, only about 45% of the firm's assets were in long, short money pools. Once again, another one bites the dust. All right? They just told you straight up, yo, we can't make money in this market anymore. We can no longer trade this market anymore. That's what they just told you. Wow. See, I told you, man, just because you got an Ivy League degree from an Ivy League school doesn't make you a trader, man. All right? I'm sure they didn't teach you this in business school. They didn't prepare y'all for the type of drubbing that you just got. You got your behinds handed to you because you thought you knew something. You thought your model was superior without real world application. You had no real world or historical data to put this on. You didn't know. You assumed. And you know what they say about that. So that being said, ladies and gentlemen, trading is the hardest yet easiest thing you will ever do in your life. I know it sounds crazy, but it's true. It is the hardest, but also the easiest. And what that means is it is the hardest thing you will do because it can take a lifetime to learn how to do if you try to do it on your own. And there's no guarantee or promise of success. All right. Very few people figure out robust trading methodologies. When we say robust, we mean methodologies that are able to perform in multiple markets, and not only just multiple markets, but also have the likelihood of continued success. All right, that's almost impossible. Wall Street has spent billions of dollars on billion-dollar machines to try to figure this thing out, and they can't do it. So they try to find people like myself to hire to come and build methodologies and systems for them. All right. But see, they treat people like me like dinosaurs because they want now the guy that graduated from MIT with a PhD in computer technology and programming to come in and program and hook up all their computers and mainframes and blah, blah, blah. But they don't get it. What they should have done is take people like myself and said, okay, let's go ahead and take your brain and program it and blah, blah, blah. But they didn't want to do that because they didn't want to pay people like me. So they got rid of the people like me. I know it sounds counterproductive. It is. So you take the dude who's making the money for you, you kick him out the way, and then you hire the professor from MIT to build your computers, and then you hope that the computer technology dude and the physicist and the mathematician that you hired will be able to come up with a trading strategy that you will own and that you can move forward, because they don't like paying people nothing. Like straight up, they hate paying people. So that's really what this is at the end of the day. At the end of the day, all it is the greed of Wall Street, and they ended up, chopping off their own foot. All right, because they didn't want to have to pay money to buy a good quality pair of sneakers to go walking in. So that's what this boils down to. That's why I do what I do, and I do it with a passion, because I want to see people succeed. All right, because they don't want you to succeed. They want you to be, reliant and dependent on them, and that you'll throw your hard-earned money their way and do exactly what they tell you to do with fear and trembling. And then they scare you to death and say, if you don't do what we say exactly how we say it, then you're going to lose all your money. Is that what you want? No, I don't want to lose all my money. Well, then do what we say and do it how we say it. And then what happens when the market's going against you and you're losing your life savings? They tell you to buy more. You don't want to miss out on this opportunity. No, I don't. You want to get your money back, don't you? Yes, I do. Okay, then you'll do what we tell you to do. See how dastardly that is, ladies and gentlemen? You see how whack that is? You see how that sounds? You see how they do you? You see how they treat you? They don't care about you. They just care about fattening their purses. And then once you've blown your account, they move on to the next person. And they say, oh, well, call me back when you get some more money. And that's just how they leave you. That's why people hate Wall Street. When you say Wall Street, they hate it. They can't stand it. It sounds ridiculous to them. You know what I mean? So, yeah, I get it. I get it. I understand. I understand why people are feeling the way they feeling some type of way. And that is because they have been disrespected for so long and they're tired of it. So, anywho, with that being said, that's all I got for today. You guys know what it is. Smash that like button and get your behinds over to PulseWaveTrading.com. You know what y'all need to do. You don't need me to tell you what you need to do. You already know what you need to do. Player, come break bread with us, man. Come see how to do this the right way. Come see how to do this correctly. All right? Not the casino way. This is not gambling. This is no get rich quick scheme. You're going to learn how to trade. You're going to learn how to trade the markets correctly. All right? This ain't black-a-jack. Okay? No. This is a business. Trading is a business and should be approached in a professional manner. All right? One that includes risk management. All right? You can't erase risk, but you can manage it. So with that being said, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. And I will catch you guys in the trading room. And everybody else, I will see this evening for the end of day report. Peace.